Hi everyone, let's go over my bullish and bearish Elliott wave scenarios on Bitcoin, starting with the bullish scenario where we are looking for a finished impulse to the upside in a wave 1 or A finished 3-wave structure in 2 or B, and now aim for continuation to the upside impulsively in a wave C or 3. 65.6k would be your minimum target. In this scenario, your wave 2/B hit the 0.382 Fibonacci. Taken from the start to the end of wave 1 or A, it is a common target for a wave B, a little less common for a wave 2, but it is a target nonetheless. This retracement to the downside here also ended after the 0.382 Fib time, which is important as by far most commonly a corrective structure corrects to at least after the 0.382 Fib time, taken from the start to the end of wave 1 or A to compare this move up in time with the move down in time. And then you can see we have the blue wave 1 and wave 2 here. Of course, not always easy to count this move to the upside as a very clean impulse because of the highest amount of volume in the high. And most commonly, if we look at an impulsive structure, 1, 2, 3, 4, 5, the highest amount of volume is not in a wave 5, but in a wave 3. However, in an impulse, it is possible to get the highest amount of volume and an extension in a wave 5, which would then be the impulsive count on a lower time frame in this structure to the upside. Then we have our wave 2 to the downside, retracing to the 0.5 Fibonacci, taken from the start to the end of the blue wave 1, which is a common target for a wave 2, 59.4k, and now the low here also works as the invalidation for this scenario. Now currently we are ranging on top of support. We passed the resistance here, so resistance can now potentially act as support. Look for signs of strength. If we hold, we're going to be looking for 63.6k to 64.3k. If you do happen to lose this support over here, there's always that potential for another 1-2 of a lower degree, and we have some support to the downside being the daily naked point of control at 60.2k. If we then look at the bearish scenario, then in the bearish scenario, we're also still looking for a 1 or A, 2 or B, and then a wave C or 3 to the upside. But here, your wave 2 or B is extended in time. It is a longer sideways corrective structure, zigzag in a W, corrective move in our wave X, and then a flat A, B, C to the downside in a wave Y. Common target for your wave B is hit the 1.236 to the 1.38 Fibonacci, taken from the start to the end of wave A, giving you a target between 61.8k and 62.2k. If price hits the 1.618 at 62.7k, the probabilities will significantly reduce for this scenario. The minimum target for your wave C would be to take out the low of wave A at 59.1k. If we then look at the base channel, the base channel is important to distinguish between a zigzag to the upside, an ABC, or an impulse to the upside being a 1, 2, 3. Now maybe based on the line that I just drew on the chart, you already get an idea of the difference. But for a zigzag, you're looking for an ABC where preferably your wave C is ending somewhere at the upper trend line of the channel. For an impulse, what we're looking for is price to escape this channel and move significantly towards the upside. If we then look at the 1-hour time frame, then last night we were live during the FOMC news. Price moved to the upside, touched the 886 here on my chart, but we actually did not take out the high. Therefore, the probabilities were higher to still take out this high at a later stage, which we did here overnight for my time zone, Central European time, and now we are ranging above this high. As mentioned, we are now also on top of support. Now, what is interesting and what is something that I do recommend to do from an Elliott wave point of view is to now continue to pull from the high to the lows, every new range, the 886. The moment the 886 is touched, the probabilities immediately increase to take out that high. Mind you that after an 886 touch, it is quite common for price to retrace to the golden pocket first. And if we then look at the CVD divergences, then you can see a bullish and a bearish CVD divergence on my chart. Now, the general recommendation is to wait for one of the CVD divergences to play out to get more clarity, because what you're eventually looking for is market structure in combination with the CVDs. What the bulls want to see is market structure to continue to the upside, higher highs, higher lows, with consistent bullish CVDs playing out, and same is true for the bears, but then of course the opposite side. And if we then look at the probabilities of the different scenarios, then in general the probabilities from an Elliott wave point of view are higher to still look for higher prices on the chart, either as an impulse or the WX and then a wave Y. In both cases, the directional bias from an Elliott wave point of view would be to look for higher prices, but the probabilities for the individual scenario very much depends on the local range that we have over here, but we have a very, very limited amount of information in this range. So therefore, it's best to keep an eye on the local market structure. I hope that this video was helpful or valuable to you. Please check out the brand new complete Elliott Waves Guide playlist I've made that shows you all you need to know about Elliott Waves. Thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.